Hello, class. Welcome to a short podcast using some financial statements to illustrate a couple of points that I want to make as we start intermediate accounting as we move forward, kind of how we're going to focus this semester. In the past, in Accounting 101, you may have found it easier to focus on journal entries and try to memorize how to make the journal entries. I'm going to make the contention that that is not the best way to do accounting. It is a step, and certainly we are going to continue to make journal entries and debits and credits, but the focus of the accounting profession and accounting rules, if we were to look at all the way through the accounting rules that are provided, and you'll learn a little bit more about it in our second module as to where to find those and how to look those up, there won't be any, well, I won't say any, but there will be very few times that the accounting rules specify journal entries as a way of how to accomplish something. Instead, the rules describe what should the ultimate product should look like. So the rules tell us what this income statement, and we're using Xerox here as an example, but we could look at any publicly traded income statement to see what it should tell us. The rules are worried about what belongs on the financial statements, how you get the numbers, and we're not talking about adding and subtracting the numbers. We're talking about what should be included or what value should be used. And there is very little, if any, discussion about how to make journal entries and what the debits and credits are. In fact, the idea is you decide what the correct disclosure is, and then the journal entries will follow suit. They will make the changes necessary to get the financial statements to look the way that they should and tell the right story. So that's the difference, sort of, we want you to start thinking about, is not so much what should I debit and what should I credit, but what should it look like when I'm done, and then go back to then what do I need to debit and credit to get to that point. So for instance, if I were working on Xerox's financial statements, looking at a balance sheet or looking at my trial balance, and I saw that inventories was listed at a certain number, $141 million in this instance. And when we did our physical count or we did our analysis of the cost of that inventory, and you just think about what it would take to verify or to go through $141 million of inventory, when we found out that that number is a different than what is listed or what we had recorded, couple of questions we'd want to ask ourselves. How did that happen, first of all? But that's kind of beyond the scope of our class. What we need to do is, what do we need to do? What journal entry or what change? And that's just what journal entries are. They're changes to accounts. What changes need to happen in order for that to be correct on the financial statements? And that's what we mean by adjusting entries. Is what is it going to take to make the numbers in our general ledger or on our trial balance show what they should. So if we needed, say for instance, in this case, the inventory was 841, and we had determined through a physical count that it was only 810, then we would need a journal entry to change it from 841 down to 810. That change is what would make the journal entry. And the reality is we could make that in multiple journal entries. We could make it in one journal entry. It doesn't matter. Nobody's going to see the journal entries. they're going to see the result. The focus is on the financial statements and the story they tell. So if you'll think about it in those terms, you'll find that it is generally easier to grasp the bigger concept than if we get too worried about the journal entries and whether or not what we debit or credit. That's important when we get to especially our correcting entries, in the sense that when we go backwards to correct things from past years, there is no way really to make journal entries. We need to correct what the amounts were disclosed. But remember, an income statement, once the year is over, is close to retained earnings. It goes away. And so any change to an income statement for a prior year can only affect retained earnings. As you think about, well, what does it change? What does it affect? What is wrong because of that error? The answer for anything in past years that has to do with the income statement is always in retained earnings, right down here. So that's kind of my contention, and our explanation that I gave you about adjusting entries gives you kind of three ways that you'll see companies do it. And there's no description in US GAAP about how to do adjusting entries. It really is not. There's no list. There's no, this is how many you need to think about. It just tells us what the result needs to be. So we need to have the right amount of inventory based on its costs and how many items we have on hand. We need to have the right amount in accounts receivable net of the allowance of what we don't think we're going to collect. Same thing on the income statement. There's no telling us what journal entries to make in order to make sure we record the expenses for our employees. In fact, we'll go back through their hours. We will figure out how much we owe them to make sure that our accrued compensation and benefit costs, for instance, here on Xerox, is correct. And that's what we actually owe them as of December 31st, 2016. And we will adjust the compensation expense to match that based on what we're able to calculate. So it's a matter of determining what it should be and then making whatever journal entries, and it could be more than one, to bring that to the point that we want it to be. And so there could be multiple right answers when it comes to adjusting entries, depending on where you are and what you're trying to get to. Some companies will make adjusting entries every month. Others will make them only at the end of the year when the financial statements are getting ready to be done. And it doesn't matter. Both are correct. Both will end up with the same result or could, if they're done correctly, it's the same result at the end of the year and tell the same story. And so the story, the financial statements, in this case Xerox, you can see that sales are down. They're being hurt by our change to the digital, right? People aren't making copies the same way they used to because they just send things electronically. Everything is, you don't need a copy of things. And so Xerox is one company that's being hurt by that, and you can see that in their sales dropping, going from a net income to a net loss. That's the story. That's the what's being portrayed. No one is worried about and looking for a particular journal entry. In fact, you can't see it. You can't see how many debits or credits there were, whether this was result of 4 or 5. All we need to do is make sure we get to the correct result, the one that represents what's really happening at the company. So hopefully that will help you focus on the right things going forward in terms of how to think about adjusting entries, correcting entries, and in fact, everything we do for the rest of the semester, the rules will focus us on what it should be, what it should look like on the financial state, what should be included in the footnotes, that sort of thing, and not so much on trying to remember or memorize certain journal entries to get there. We'll identify what asset needs to change, what liability needs to change, and hopefully from your work in accounting 101, you'll remember that to make a liability go up, you need a credit. To make it go down is a debit, and just the opposite for assets. And that will guide what will ultimately make our journal entries. But we'll think in terms of what we want to accomplish, what we need, where we need to get to.